On the 8th of March, 2022, inside the polished glass offices of the London Metal Exchange, the screens flashed red as the financial world witnessed the most insane 24 hours in the history of global commodities. The price of nickel, a boring grey metal used to make stainless steel and electric vehicle batteries, didn't just go up, it exploded. In a matter of hours, nickel skyrocketed from $20,000 a ton to an unthinkable $100,000 a ton. On Wall Street, predatory hedge funds and international investment banks were breaking out champagne. They believed they had orchestrated the ultimate trap. They had cornered a Chinese tycoon named Xiang Guangda in a $10 billion short squeeze that was supposed to bankrupt his entire industrial empire overnight. But what Wall Street didn't realize was that they weren't playing chess with an ordinary businessman. They were picking a fight with the Nickel King, a man who controlled the physical backbone of the world's metal supply. And instead of surrendering, he was about to unleash a counterattack that would bring the world's oldest metal exchange to its knees and force the financial elites to rewrite their own rules. To understand how this epic financial war began, you have to look at the man Wall Street tried to destroy. Xiang Guangda didn't start his career in a fancy trading firm with a Harvard degree. In the 1980s, he was a humble mechanic in eastern China, working in a workshop making doors and windows for automobiles. But Xiang had an uncanny ability to spot industrial trends before anyone else. He noticed that as China's economy grew, the nation's demand for stainless steel would become insatiable. Stainless steel requires nickel. The problem was that refining nickel was expensive, dirty, and slow. Xiang founded a company called Tsingshan Holding Group and spent the next 30 years quietly building a global monopoly. He pioneered a revolutionary, low-cost manufacturing process that allowed him to produce nickel pig iron at a fraction of his competitors' costs. While Western mining companies moved slowly, Xiang bought up massive nickel reserves in Indonesia, built deep-sea ports, constructed coal-fired power plants in the middle of jungles, and turned Tsingshan into the largest nickel producer on Earth. By 2022, Xiang Guangda controlled over 20% of the global nickel market. But in the world of heavy industry, owning mines isn't enough. You also have to navigate the volatile world of high finance. And that is where Xiang set the stage for his own near destruction. In commodities trading, physical producers like Tsingshan routinely use financial markets to protect themselves against falling prices. This is called hedging, and it relies on taking what is known as a short position. It sounds like complicated financial wizardry, but it is actually a very simple, devious trick. Imagine your friend owns a brand new, ultra-rare smartphone worth $1,000. You ask to borrow that phone for a week. The exact second he hands it to you, you secretly sell it to a stranger for $1,000 cash in your pocket. Why would you do this? Because you have inside information that next week the company is releasing a better model and this current phone's price will crash to $200. Your plan is simple. Wait for the price to drop, buy the exact same phone back on eBay for $200, hand it back to your friend, and walk away with $800 in pure profit without ever manufacturing a single phone yourself. But here is the deadly trap. What if your information was wrong? What if, instead of crashing, the phone suddenly becomes a viral collector's item and the price skyrockets to $10,000? Your friend demands his phone back immediately. You are legally forced to open your own wallet, buy that phone for $10,000, and hand it over, losing $9,000 of your own money in a single afternoon. The higher the price goes, the more money you lose. And the losses have absolutely no limit. Xiang Guangda believed nickel prices were going to fall in 2022 because his massive new factories in Indonesia were about to flood the market with cheap metal. To lock in his profits, he took out an enormous short position on the London Metal Exchange, equivalent to 150,000 tons of nickel. He was effectively betting that nickel prices would go down. But on Wall Street, a group of powerful hedge funds and investment banks, including giants like JP Morgan, noticed something extraordinary. Xiang's short position was so big that he was responsible for almost a fifth of all open nickel contracts on the exchange. And, more importantly, Wall Street noticed a fatal flaw in Xiang's strategy, a microscopic rule in the exchange's handbook that they could exploit to wipe him out completely. This flaw came down to the exact type of nickel Xiang produced. The London Metal Exchange only allowed traders to settle their short contracts using what is known as Class 1 nickel, which is ultra-pure, 99.8% pure metal. But Xiang's factories produced Class 2 nickel, a lower-grade nickel matte used for steel and batteries. Even though Xiang owned mountains of physical nickel in his warehouses, he could not legally deliver it to the exchange to clear his short position. He had to pay off his contracts in raw cash or physically buy Class 1 nickel on the open market, and Wall Street knew that there was almost no Class 1 nickel available in global warehouses. In February 2022, Russia invaded Ukraine. Russia happened to be the world's largest exporter of high-grade Class 1 nickel. When Western nations slapped heavy sanctions on Russian metals, the supply of Class 1 nickel instantly dried up. Wall Street smelled blood in the water. They realized that Xiang Guangda was completely trapped. He couldn't deliver his own nickel, he couldn't buy Russian nickel, and his short position was bleeding cash. A coalition of aggressive hedge funds launched a coordinated attack. They began buying up every available futures contract of Class 1 nickel, artificially driving the price higher and higher. This was a classic predatory short squeeze. By driving the price of nickel through the roof, they were forcing Xiang to post billions of dollars in daily cash payments, known as margin calls, just to keep his position open. If Xiang ran out of cash to cover his margin calls, the exchange would automatically liquidate his positions, forcing him to buy back his contracts at record high prices. Wall Street calculated that Xiang would lose up to $10 billion, go bankrupt, and be forced to hand over his Indonesian nickel mines and steel factories to Western banks for pennies on the dollar. On the 7th of March, 2022, Wall Street pulled the trigger. They flooded the London Metal Exchange with buy orders. The price of nickel jumped 60% in a single day, breaking $30,000, then $40,000, then $50,000. Inside Tsingshan's headquarters in China, Xiang's phone was ringing non-stop. His brokers informed him that he owed over $1 billion in margin calls by the end of the day. If he didn't pay, his firm would be declared in default by morning. But Xiang refused to crack. He used his personal relationships to wire hundreds of millions of dollars from his personal accounts and secured short-term credit from friendly domestic institutions. He survived the night. But Wall Street wasn't done. The next morning, March 8, at 1 a.m. London time, the market reopened, and Wall Street unleashed total chaos. Algorithmic trading bots bought nickel at lightning speed. Within hours, The price shot up from $50,000 to $60,000, then $80,000, and finally breached an insane $100,000 per ton. In less than 48 hours, nickel prices had risen by over 250%. Xiang Guangda's paper losses officially crossed the $10 billion mark. Wall Street traders were screaming with excitement on trading floors from London to New York. They were on the verge of pulling off the biggest corporate execution in modern financial history. Inside the London Metal Exchange, however, absolute panic set in. The squeeze had become so massive that it wasn't just Xiang who was about to go under. The financial institutions that brokered his trades, including a major state-owned Chinese bank, were now facing multi-billion-dollar margin calls that they could not pay. If Xiang defaulted, his brokers would default, and if the brokers defaulted, the London Metal Exchange's central clearinghouse would collapse. The entire global metal trading system was hours away from complete financial meltdown. Wall Street had built a bomb so large that it was about to destroy the very house they were standing in. That was the exact moment Xiang Guangda made his move. While Wall Street thought he was cowering in fear, Xiang was quietly pulling levers at the highest levels of global business and diplomacy. He called an emergency summit with executives from major Chinese state banks, foreign commercial lenders, and global commodity traders. Xiang presented a simple, ruthless argument. If Wall Street brings me down, they bring all of you down with me. But if you stand behind me, we can break their trap. Xiang pledged his physical assets, his vast nickel mines, coal plants, and steel mills in Indonesia as collateral. Seeing the strategic importance of protecting China's industrial supply chain, a syndicate of international and Chinese banks agreed to provide Xiang with a massive, multi-billion-dollar emergency credit facility to cover his margin calls. With billions of dollars in cash backing him up, Xiang delivered a terrifying message to Wall Street. He wasn't going to buy back his short positions at inflated prices. Instead, he had made a secret deal with Chinese state stockpiles to swap his low-grade nickel for tens of thousands of tons of Class 1 nickel. He was preparing to ship physical high-grade nickel directly to London and dump it onto the exchange floor. If Xiang delivered the physical metal, the artificial shortage would vanish overnight. Nickel prices would collapse back to earth, and the hedge funds that bought at $100,000 a ton would lose every single penny they had invested. Wall Street suddenly realized their trap had inverted. They were now holding billions of dollars of absurdly overpriced nickel contracts that no one in the real world would ever buy. Panic swept through the hedge funds. If the market stayed open, they were the ones who were going to be wiped out. At 8:15 a.m. on the 8th of March 2022, the London Metal Exchange did something that shocked the financial world to its core. They hit the emergency stop button. For the first time in 33 years, the exchange halted all nickel trading. But they didn't stop there. Facing the complete destruction of their clearing system and massive Wall Street losses, the board of the exchange made an unprecedented decision. They officially cancelled every single trade executed on the morning of March 8th. They literally erased 4 hours of trading, wiped out nearly $4 billion in Wall Street profits, and artificially reset the price of nickel back to $48,000 per ton. Wall Street hedge funds were furious. Major investment firms like Elliott Management and Jane Street sued the London Metal Exchange for hundreds of millions of dollars, accusing the exchange of committing outright market manipulation to save a Chinese tycoon. But the intervention gave Xiang Guangda the exact breathing room he needed. Over the next few days, Xiang negotiated a standstill agreement with his banking syndicate. With prices stabilized, he systematically and quietly unwound his massive short position over several months without paying Wall Street a single dime in predatory profits. When the dust finally settled, Xiang Guangda emerged from the $10 billion knife fight with his empire completely intact. He didn't lose his mines, he didn't lose his factories, and he retained his title as the undisputed nickel king. The story of the 2022 nickel squeeze became an instant legend in the world of high finance. It exposed the fragile illusion of paper markets, where high-frequency trading bots and hedge fund algorithms think they control the world. In the end, a former auto mechanic from China reminded Wall Street of a fundamental law of economics. Paper wealth can disappear with the flip of a switch, but the man who controls the physical metal controls the world.